a little bit about the market, okay? Because I have seen this post comparing the crash in 2008 and the current market. I'm not sure that we are in the same situation, and let me explain why. Right now, you can see on the left we have the S&P 500 from is 3 years of data, okay, just before the crash, 3 years before, and on the right we have the current market 3 years before, okay. So in 2008, how you can see, the market was consistently going up until at some point in July we have this red candle. We are talking about 13%. The correction that we have right now, that we had, it was 9%. So it's similar? Not quite. The stock market, the S&P 500 was going up with pullbacks. It was like a really nice uptrend. But now we had in the last 2 years this consolidation, and the market this year just started rally. Okay? Do we have the same situation that triggered the crash in 2008 with the real estate? I don't think so. Based on what I have seen the last 2 weeks, the real estate stocks, they are moving up. So I don't think that the chart is similar. And also because if you expand a little bit more in 2008, so how you can see here, this is the crash in 2000.com and then the crash 2008. And what I want you to see here is that you have the market topping, testing the all-time high from 8 years before and rejecting that level. So this, you can call it double top or whatever you want, but this is a rejection of the previous level. And probably they were too close. And at the end, support and resistance, they exist because people have memory. I think elders said that. Anyhow, in 2008, the stock was testing the same all-time high from the .com, right? It rejected, and at the same time, we had this situation with the real estate that accelerated the crash, and it went down. Right now, if we move here, 2 years ago we had this consolidation. The market started rallying this year, and we are at all-time high. This little crash here doesn't mean too much. Okay, so I don't think that the chart is the same. I don't think that we are in the same situation technically. In that case, I don't think it's the same situation. Now, if you look based on the Fed rate cuts, then, well, that's a situation that worry me a little bit, because we have Fed cuts in two types of situation previously. Okay, if you go all the way back to 94, here you can see the double top. The market trying to break this previous top on the .com bubble. Again, we are not in the same situation. But in the Fed rate, in the cuts, there are two situations that happen here. For example, in 98, we had a crisis, currency crisis, and the Fed acted after the crisis happened, and that was bullish for the market. The same thing happened in 2000, actually, after the crash, 1 year after, the Fed started acting, and eventually that was bullish for the market. Okay? Now, we have another situation that happened in 2008 where the market was at all-time high, and before the crisis, the Fed started cutting rates. And in this case, it seems that that accelerated the way down. Probably the Feds already knew what was happening behind the scene, and for that reason, they started acting before. So there is a situation there where people is gonna start selling the position to close the previous loans because they are expecting to get to borrow money in the future at lower rates. So that could be an acceleration of the downtrend, but that's something that is on my head. There is no exactly indication of that yet. So do I think that we are in the same situation from 2008? No. Are we in the same situation from 2000? Well, that's different. Because the weakness that you see here from the last 5 weeks, that weakness was in technology based on the AI. So are we closer to 2000? Maybe. But the rally at that moment, it rallied for several years, 256. After this consolidation, we have rallied 56%. So technically, still, I think that we are in a bull market, and probably it's gonna last a little bit more. Maybe I'm wrong. Maybe we crash tomorrow, but first, we can only act based on what we learned from the past, what we are seeing today. And if we crash tomorrow, it doesn't matter. It doesn't matter if you follow the rules, if you invest or trade based on certain rules, what you can trade if you have a stop loss. Because if tomorrow you see a gap down and you are a stop out, yeah, and you were investing or trading 2% or whatever rules you decide, you want to see the market going down from outside. The problem is if you don't have stop losses. If your money management, risk management, your position, you don't have any plan, well, that could be a problem. Because you're going to see the market and you're going to write it down. If you have a stop loss and you are to stop it out, you're fine. And that's what we can do. Basically, at the end, this is money management, risk management, and we play our setups based on probability, what we learn, and we try to make a little bit more on the winners and close really fast on the losers. If you find yourself getting anxious, just let me go to the daily. If you find yourself getting anxious because the market went 1% down on Thursday and today less than 1%, probably you are overextended. Probably you need to reduce your position and get to one level where you are in peace. Because right now, if we go to the short-term chart, we are in a bull market. We have been rallying. We had a pullback on April. We rallied again. We had a pullback with a higher low on huge volume. Now, because this is something else. If you compare volume, let me go back quickly. Okay, if you compare volume on 2008, look at this. Compare with our pullback. We don't have negative participation right now. Actually, we had a little bit on 2020, and it was bad because it was really fast. But again, you have stop loss. Probably you have been a stop out here, and you have been out of the market all this way, or maybe short in the market if you also like to short. I really don't think that this is a problem. And actually, when this pullback happened, right here, I started shorting the market, and I sold it around here. Mistake, but anyhow, and I gonna show you why in this video, why I was shorting this market right here. It was going up. So again, higher lows, reaction, like a change of character with huge volume. We are testing the all-time high, still good. Set your stop loss accordingly. Nasdaq is weaker, but still same situation. Higher lows, change of character with a lot of volume. But it's not the recovery is not exactly like S&P 500. So tech is weaker. At least this is what I see right now. For that reason, I reduced a little bit Nvidia today. My decision to do it is because my options they are a short term, they are not good, and I was overextended. But I still have, and I still gonna play this earning call. I have my stop loss. If let's say that the earning call goes down and open 110, that's fine. I have my stop loss. I'm gonna be a stop out. Probably I lose a little bit more than usual, but I have been playing all these. So that's the whole point. Maximize your gains, cut losses quickly. So Nvidia and Apple, they are good. There's no reason to panic yet, right? Going back to S&P 500, I was saying that I shorted the market around here. That is something that I do on the weekend. Probably I'm gonna start adding that analysis to the market. It's very simple. So it's basically what's happening in the S&P 500, what's happening in Nasdaq to Russell 2000. Based on all these index, they are going up, higher lows, good volume on the reaction. So at this moment, maybe tomorrow we are in a crash, but at this moment, we are in a bull market. If you joined all these people, well, let me say, if I joined all these people that are all the time calling for the crash, eventually they're gonna be right, but I'm gonna be losing all this. I just want to see the market is going up. I'm gonna join the market. It's going down. I'm gonna step out. Maybe I short if I see it. There is something that is called advanced and declining issues, or breadth indicator. So basically you have, this is the breadth indicator for S&P 500. This is the chart for, well, this is Nasdaq. So let me change it quickly. This is the chart for the S&P 500. This is the breadth indicator that is up and down daily. So you need to plot the moving average. 20, I use 20 for short term, 50 for mid long term, and 100 is long term, right? And this is gonna smooth the line from me, and I'm gonna be able to see all these, create some order on these scales, and then easily I'm gonna see the divergence. So let me hide 100 because we don't need it for this. So basically the index has been going up, but all the companies from that index, the majority of the companies from that index, they are going down. So this is the advancing and decline. It's basically how many stocks from the index is doing new highs and how many they are doing new lows. So the index is going up, but in the meantime, almost all of them, all the stocks individually in the price, they are going down. Same thing for the long term. So this divergence is important when they are on the maximum values, when they are close to extreme. So the stock also, the index, sorry, was also going up in this situation, but almost all the stocks from the index, they were going down. So for that reason, I decided to short here. And what happened after? What happened here? It went down. And probably if I go a little bit longer, let me put this 3 years, we're gonna find some divergence also like here, for example, and here. Well, these are, let's put the meaningful ones. Okay, so we have something there. Now the market was going down here, so it's not important because again, divergence, they are important when they are on the extreme. If I go to Nasdaq breadth indicator, okay, this is the Nasdaq. Let me change the symbol for Nasdaq to compare. Okay, so we have the index here going up, but almost all the companies, actually, you can see the difference here is more. And after this divergence, what happened with the stock and the stock market? There was a correction. The same thing happened here. I didn't short Nasdaq. I only shorted S&P 500. But again, you get the idea. This is basically, this is something really important that I look at. And when I see this divergence on the extreme, well, probably it's time to step out or short the market, or if you only like to go long, you can play stocks or sectors that they trade in the opposite way. That happened too. Okay. So this breadth indicator, they are super useful. Something that I'm looking right now that is I like it a lot is let me change here to daily, is the COT. COT. This is very nice. If you go to the features, S&P 500, for example, when you see that commercial, that is a red one, is in the negative, probably it's a bad indication here. When it's starting acting, getting involved in the market, well, you can see that there is some kind of reversal and then continue. Right now it's insignificant. Both sides, the same thing for the Nasdaq. So it's growing a little bit more to the downside. So yeah, it's some kind of alert. I'm gonna be watching on that. And there is another chart that I look. Yeah, this is the one that I'm trying right now. In the yellow line, you see the market, and then you see the red one, the amount of puts premium, and then green, the amount of calls premium. And yes, when the amount of calls goes down, the market kind of follow. And right now it's not in the stream, but it's kind of low. Are we close to another pullback? Maybe. Are we close? Yeah, that's more likely. It could happen, or at least some consolidation on this level. But that doesn't mean that we are in a recession. Probably we're gonna have to wait a little bit more to see how the market is gonna react based on the rate cuts. Okay, so going back to S&P 500, that's where we are right now. Let's see what happens. But again, I trade based on what I see, based on what happened in the short term, long term. I manage my risk. I put my stop loss, and if I'm out, well, if it's something is coming, I'm gonna be out, and I'm gonna see the market drop. But no big deal.